Hi everyone, hope you're all doing well, and today I'm doing my free UK stocks to buy June 2021 edition. Now normally I do this video series in front of the whiteboard. I'm currently away at the moment, so I can't do my video series which I normally do in front of the whiteboard, but I'm sure this is still okay as I can do a lot of screen recordings and stuff like that. But yeah, otherwise there would have been no video today, and I wanted to kind of really do this one because I thought this is a good opportunity right now to do this video series. We didn't do one last month just because of how many growth stocks were selling off, and I was kind of just putting videos out every single day talking about growth stocks because when we had a big massive chance in the US stock market to buy some amazing companies, some amazing US growth stocks that are sold off like and lost half the value, those are amazing opportunities that don't come around every so often. So you've got to really take them opportunities as much as you can, and that's what I was doing, and that's why there were no free UK stocks to buy series. As well as that, I think like a lot of the UK stocks have performed very well, and over the last few months have been at decent valuations, and that's why I've been trimming some of my shares. You know, like the other month I was like selling a few shares in my like Greg's position that's up a little bit and stuff like that. I thought the UK stocks have performed very well, and because they're performing very well, it was very hard to identify some opportunities to go buy on the UK stock market. But recently a few UK stocks are starting to dip, and because of that I think there's some good opportunities starting to appear. I'm going to share with you today the three opportunities that look decent to me. I'm still not exactly buying them, but I am pretty close, and I will be keeping a very close eye on them this month in case they do go lower and I do end up buying them. So I'm not exactly buying these three right now, but they are very close to me buying, and as well as that I do want to get my cash pile up a little bit. So I am considering these three, and they are quite close to buying, but not just yet. But like I said, there's some good opportunities starting to appear at last on the UK front. So yeah, we'll take a look at these. As always, if you do want to join the page to find out if I do buy or sell any stocks, the link is in the description. There's also a Discord on there, portfolio reviews, private Q&A sessions, there's education video series that we do on there, and yeah, there's a lot of great stuff on there in my opinion, and I'm trying not to be biased about it. I think I saw the other day like someone else's like private group was like $450 like a year or something, and I was like, whoa, maybe I need to start upping my prices. I'm only joking, I'm not going to up the prices, but yeah, for what is on there for the price, I think it's not too bad at all in my opinion. But we'll get stuck into the free UK stocks to buy June 2021 edition. So starting off with is a company that I said that I might do its own video on, but I wanted to put it in the free UK stocks to buy series as well, so I might make its own video. This one is starting to get very tempting to me. It is a company called Team 17. So these guys make video games. They're a bit more of like independent titles, more indie games, not hugely well known games, but still very successful. And of course, these guys really benefited from the CV situation that we had in 2020. But even in 2021, you know, the 2020 growth was insanely good because of the help of the CV situation. Sure, they're not going to do that again in 2021, and maybe not ever, I guess, really, but still, historically, this company is putting very good profit growth, very good revenue growth, and it should still do that even after this CV situation. Sure, it might have a cooling off period, and that might be reflected in the share price and what's kind of happening right now, but in the long run, still a great company, has a very good management team behind it. So if you actually have a look at the share price over a 5-year period, you can see here this is when they actually came onto the stock market. Still had a very good 2019, 2020 very good because of the CV situation, and if we go just zooming right now off 52-week highs, it is down a little bit off its 52-week highs at the moment. So if I mean, I like buying companies on dips because when you buy companies on the dip, your upside potential is increased, and as well as that, you know, the risk of you going down suddenly is also reduced. I've got plenty of videos on that, loads of reasons why to buy on a dip. But this company originally was trading like only a few months ago at a P. This is probably the only little red flag I do have with this company, is the company was trading at like a 60 P ratio. Now, ideally, I want to get this company because it grows at normally a 10% revenue rate. To pay up for a company that grows at that much rate at like a 60p is very high. And obviously, it's had a boom at the moment. Share price has done really well, and the only big thing that puts me off buying this at the moment is the valuation, because everything else for the company is fantastic. But yeah, a 42p ratio for a company that only grows at 10% revenue, I say only, but it's still fantastic. But a 10% revenue growth rate, trading at a 42p ratio is still a little high. Ideally, it does need to come down to the 30-ish. That's where I'm a little bit more happy. But in general, a lot of the UK gaming companies And I've been actually going through a few of the UK gaming companies at the moment, see if there's any ones that I'm considering buying. There's a few tempting ones to be fair. I think Team 17 could be the best one. I'm actually thinking of doing a complete comparison video against the UK gaming companies, because as well as that, this is like my industry that I really like buying in is like the technology sector, especially if I'm going into like the gaming stocks. As you guys know, if you look at my portfolio before, Skills, Turtle Beach, Corsair, it's a sector I do like going into. I've got quite a good knowledge in it. So obviously I always say, buy things that you have good knowledge in and use that to your advantage. And for me, this is one of my sectors that I'm quite strong in. And yeah, I would like to buy it. That's the only red flag I do have with this, and why I've not pulled the trigger yet, is because it still trades at like a pretty decent valuation. So yes, that's the only little thing that's kind of put me off it. But the earnings that it has put out, obviously the CV numbers helped it, and that's probably why the share price should cool off for the next few months, and then it should go back to growing if it carries on performing very well, which you would expect from this management team. But the recent earnings were just absolutely amazing. You can see how the company's been growing with its record performance. 12 titles released, 10 new games launched, including 2 generation launches, second studio established in Media City, Manchester, and also they purchased this one here. This was a new purchase they actually did at the start of this year. Golf With Your Friends was a company they bought. I can't remember the exact amount they actually bought this for. I think it was a fair bit of money for a company their size. So yeah, this company always carries on expanding. It never stays still, and that's what I really like about the management team. And actually, when we get onto the balance sheet as well, which is a very good balance sheet, this is as well, because the company's making profit and making good amounts of profit. The balance sheet's getting stronger and stronger because it has a good cash position. I could actually see it go out and buying a few more companies as well going forward. So what I'm going to do now is I'm just going to go back onto their actual past performance. Actually, if I just go on the P ratio here, you can see actually a simple Wall Street say it's 39, but you can see the industry in general does trade at a bit of a high valuation, but still when it's a P ratio of this rate and it's like a normal like 10% revenue growth rate, you only have to look at Boohoo that grows at like 30%, and that trades at like a 45 P ratio, and it's like, that's the only thing that I always have struggle with this company with. But if I go across to the actual past revenue performance and the profit growth, you can see here, look at this revenue growth on this company, insane. It's just moving in the right direction, and that's why the share price has moved in the right direction. And even 2019, we're here, look at this. 2019 was still a very strong year for the company. And that's before the CV times, and you can see profits just increasing, revenues increasing, 26% profit margin on this company. It's just very attractive from that point of view. Management have always grown their company at a very good rate, profit wise, revenue wise. And here we go on the balance sheet, and this is what I mean about the balance sheet. I don't ever expect this. As far as I'm aware, I don't think this company actually does pay a dividend. Sometimes Simple Wall Street can be wrong, but I don't think they do pay a dividend, and I wouldn't expect them to. A company like this, normally what they'll do is they'll actually use their cash balance to go buy new gaming titles. That's what happens a lot in the gaming industry. They don't really pay dividends, and they're more focused on buying out other companies. But this company as well, you can see the balance sheet got sorted in around 2018, roughly when they actually came public. And you look at the balance sheet, it's just got stronger and stronger. No debt on that balance sheet now. Sitting on a really healthy cash balance here. So you got a lovely cash balance there that they can, for a company that is, I think they're about 800 million, I believe it is, and they're sitting on that amount of cash. Very, very healthy cash balance as well. And on the insider front here, not much selling out here. In fact, the only thing is actual buying on the insider front. And the other thing that you really like when you're looking into these sort of companies is, one thing that I always like is seeing that the management team hold a big percentage of the company, and know they've got skin in the game, and it's benefit them that the company performs well. And you can see here the CEO holds a massive amount of shares in the company as well as not really letting go of any of them shares. So that's always a really good thing for me. So yeah, I'm going to be watching this one very closely, see if it can go down a little more, but it's very, very attractive to me. And even at the moment, I would still rate it that it will do very well. I just want to get that P ratio down maybe a little bit, but yeah, number one is Team 17. Number two is the only company on the free UK stocks to buy June 2021 edition that I actually own at the moment, which is Hotel Chocolat. At the moment, this company is 471 million. The only thing about this company is that there's a lot of, for your actual trades to go through, it can sometimes take a little bit, but this company is kind of being a bit flat at the moment. I think on my position, I'm currently down like 7%, I believe, on this one. So I'm considering buying a little bit more of this company at the moment, but what I really like about this company is their recent earnings they brought out. So this is their recent earnings. Revenue. Now this came through the CV situation. Now Hotel Chocolat basically has a lot of their retail stores. You think about retail's been killed off the last year, but these guys put so impressive numbers to say their stores were closed, and now you consider, okay, we're going to have probably an economic boom. People are going to go back on the high street, which these guys have so many high street stores. So you look at these numbers that they did with their stores closed. Now they have the stores open. Sure, the online growth, which grew huge amounts, which you can see here, was amazing, and that might slow down a little bit now that high street stores are open. But you think, okay, even if they can just keep a little bit of this online growth and the high street growth, plus the international growth that they have just started, so they've just basically moved international as well, I think these guys can put in some really, really good numbers. So this is, like I say, this is during a really bad year for high street stores. Revenue up 11%, profit before tax up 3%. Very strong numbers. If we can go here, UK sales grew by 12%, and also if we go on here, 51% of UK sales in the period from direct to consumers digital. Digital-led growth in the US, sales grew by 22%, and Japanese joint venture sales to consumers grew 228%. So this is the start of the online growth and also international growth for Hotel Chocolat. I think they're going to do some really impressive numbers, as well as the brick and mortar stores finally being open. Now, if we look at what they're actually going to do financial wise, profit has grown steadily, revenue's grown steadily. I think that now they've got online sales and international growth, I think these numbers will even hype up a little bit more, revenue and profit growth front. I think they might be even a little stronger than that forecast here on Simply Wall Street, in fact. And on the balance sheet point of view as well, once again, stronger balance sheet as the years have gone on. You look at that balance sheet, the debt being reducing, as well as getting stronger and stronger amount of assets on the company as well. Sitting on a very healthy cash balance as well for a company like this, zero debt, like I said before. And these guys used to pay a dividend, they've stopped the dividend at the moment. When the high street stores actually open back up, can see this dividend actually coming back. And once again, you know, one thing that you'd like to always see is that the insiders have a good amount of shareholding inside this company. And recently what has happened, there has been some insider buying in the company. There was a little bit of selling a while ago, but recently more buying than selling. And once again, insiders co-founders holding a big amount of shares in their position once in the company. Again, no selling here, and that's what I really like. So I think you've got a strong company here that's still only just recovering from the CV situation, decent valuation, a little bit of sell-off, insiders are holding, good balance sheet, and we might see a little bit of a dividend coming at some point, I guess. Number 3 is best of the best. So I featured this one actually the last time I did the series 2 months ago, because I didn't do the one last month, so this was on 2 months ago. And yeah, I kind of looked at this one and I was like, it's been on the one thing is that makes me a bit nervous about this one is that it's just been on a very good run. And I was like, it's been on too good a run. Like, I think that the problem is when you buy something that shoots up so quick, the chances of it pulling back, you know, you think about all these people here that are on profit and might go, yeah, I'm going to sell a bit of profit. I think there could be a risk that some of these do. And as well as that, I guess the only little negative that I did have with this one is that it's sitting at a market cap of 233 million. That's a very small company as well. And once again, could have a few problems if, you know, you look at the chart here, you know, you could have a few problems if you want to buy it or sell shares. You might have to wait a little bit from them orders to kind of go through. But yeah, one thing that really put me off is that it has been on a good run. Nevertheless, though it has been on a good run, this company's still trading at a 29 P ratio. So yeah, it's still not a crazy valuation, even though it's been on such a crazy run. But like I say, the big thing is that it's been on too good a run. So what's happened now is it's actually started to pull back. If I can go on here, you see the company's actually down 26%. So maybe if this actually got down a little bit more, maybe to the 30% range, maybe I could consider buying some. There's a part of me thinking, okay, what I could actually go do is just buy a little bit, and then if it does go up, you know, I've still got some involvement in here. But and then I can average down if it does go the wrong way. But there is a part of me as well going, it's still been on a crazy run, the amount that it's gone up. But saying that, I still think it's early days, and I think this company has a lot of potential going forward, which I'll show you in a second. So basically, Best of the Best operates these competitions, which are online competitions. So basically what these guys have done recently is they moved from a competition where you could go into the mostly in airports, you go enter into a raffle, and it gives you a chance to win, an amazing car. They do other prizes as well now, like designer watches and things like that. But basically you buy raffle tickets, competitions, go into the competitions, and it gives you a chance to win one of these prizes. Now these guys, like I said, used to operate in airports. They've now got rid of that and gone to an online business model only, and they've been very aggressive on the advertisement front through Instagram, Facebook, growing the social media platforms, and the financial numbers, which I'll show you in a second, are just absolutely insane. But basically that's how the business model works. If I actually go into the financial here, you can see what they've recently brought out, and that change that they did was only in the last 6 months. Total revenue here, 22 million, up from 7.6 million. Insane. Profit before tax, 6.8 million compared to 1.3 million. It's just nuts, a nuts amount of number. And yeah, the amount of profit is just leading to a strong cash balance as well. And it just says here, strong performance reflects the move to a pure online model with continued growth in consumer acquisitions. So if I just go on to Wall Street, you can see it. Like I said, the one thing that I guess as well is like that 242 million market cap. It is a very small company, I guess. But if we do go on the actual performance of the company, you can see here, revenue steadily increased, profit steadily increased, but boom, we've got this jump, and this jump is expected to still carry on growing. And I kind of agree. Like, I can't see for any reason this company kind of just falling off the cliff all of a sudden, have to put in this amount of growth. Like, I think if they still carry on doing what they're doing, aggressive online advertising through Facebook, through Instagram, I'm sure you've probably seen some of their ads actually, I can't see the growth slowing down anytime soon. Sure, it might not be as good as the instant switch, but I think these guys could continue putting in amazing growth as well. And on the balance sheet point of view, it's a very strong balance sheet. When you look at there's no debt on there, and for an online company, you won't expect that much debt. It's got 11 million cash. You think as well they won't have that many overheads now being online. That should lead to more profit. Profit goes straight onto that balance sheet. And I actually didn't realise this until I watched Osborne Foreman, who actually featured this stock as well recently. I didn't really pay much attention to this, but he made a very good point. This company does pay a little bit of a dividend yield, and I've noticed recently, like my legal and general dividend, my Rightmove, my 888 Casinos dividend, sometimes you don't appreciate these little dividends that you collect every so often. They do start to really add up. But they do pay a slight little dividend. But the thing is their payout ratio is like 4%. And you're thinking, well, they're going to have all this cash soon. They're going to be a profit beast monster. What could they potentially do? They could pay more dividend, maybe a special dividend. And maybe that 4%, that's nothing. Maybe it goes to a 4% to a 10% payout ratio, or a 20% payout ratio. I mean, that's doubling your dividend up quite a fair bit. I mean, even tripling or quadrupling. And you pick up a really nice dividend as well. So this could actually come a growth company with a dividend, which would be very interesting to see what they'll do here. And as well as that, once again, on the insider holding, you've got a big insider holding inside the company as well. The only little thing that is a little bit different to the other ones is here, you can see they have released some shares, I guess. But I guess with how the share performance has been, with it going up 600% within the last year, you've always got to remember the insiders are very much like me and you. They've got skin in the game, and if they've held these shares for many years, you can't blame them for kind of letting go some of these shares when they've gone up that much. Me and you would do the exact same thing. So I guess it's one thing to kind of watch and go, we still want them to have a big majority holding here, but if they did release some shares, it wouldn't be awful, I guess. So yeah, just something to keep an eye on, but they still do have a look at the insiders here. There's still quite a fair bit in here, I guess, so that's still all good. So yeah, this is definitely really interesting to me. I'm kind of considering it. Still not made my mind up 100% on this one. I think if it was to go down maybe a little more, that could see me buying, because I haven't bought many UK stocks for a while. I do want to build up my cash pile still. That's one of my priorities. But yeah, some UK stocks are like dipping a little bit at the moment. and I haven't bought any for a while, and I might take advantage, and this is one that I am considering. But yeah, hope you enjoyed it. If you could smash the like button, if you're new, subscribe. Let me know what UK stocks you are considering as well. I'm always interested to hear what you guys are thinking. And a lot of you guys messaged me a while ago going, Team 17's going back down again. And because I might have missed it if it wasn't for you guys, but because you doing that, let me knew that it was dipping and I could feature it. But yeah, I know Games Workshop's one that always gets a shout. I love that one. A bit more of a sell-off would be pretty cool on that one. Right Move nearly made a list again. Airtel Africa, I guess, as well. Solid dividend play. So yeah, there's a few out there that are coming very interesting, I guess. So yeah, hopefully we can cover a few more UK stocks once again now. A few of them are selling off on the channel as well. But hope you enjoyed it, as always, and I'll see you in the next video.